Another major story this week, of course, has been gold. It continued its upward march this week as investors began to consider earlier rate rises and, of course, the prospect of inflation. The precious metal also benefited from continued weakness in the U.S. dollar. Gold touched a new all-time high. However, it should be noted that when adjusted for inflation, gold moved very close to the $2,000 US mark per each ounce back in 1980. Earlier today, I caught up with James Turk. He's the founder and CEO of Gold Money, and asked him why the precious metal has gone through historical highs this week.
Well, I think we're seeing a scramble for physical metal. You know, things changed during the summer. There were a couple of important events. One was Greenlight, which is a big hedge fund, decided to switch out of GLD, the gold ETF, into physical metal. They didn't announce why they did that or made that decision, but it got a lot of people thinking that maybe they should own physical metal instead of paper gold as well. And so there's been a scramble. We've seen it in terms of the way the metal market's been trading, and there is a tightness in the physical side. And at the end of the day, it's the demand for physical metal that really drives the gold price.
That is interesting because we had seen enormous ETF participation in the first part of the year. I think 450 million ounces in the first quarter alone. That slowed to only about 700,000 ounces in the third quarter. My suspicion was that investor demand was drawing up a little bit as equity markets gained traction, but now we have this big shift.
Yeah, exactly. Even though the ETF demand, as measured by GLD, has basically gone sideways for several months, the gold price has gone from under $900 now to a new record high at $1,050. So it really shows that once again the physical market is driving the price of gold, and I think the scramble is going to continue through the end of the year.
The thing is, though, it's hard to disentangle that from the dollar weakness. And a cynic might look at this and just say, look, this is dollar arithmetic. The dollar weakens up. Gold price is naturally going to rise. Yeah. How much more is it?
Well, you're absolutely right. You know, gold is actually influenced by many different things, and the dollar, of course, does have an impact. But at the end of the day, a strong dollar or a weak dollar doesn't really matter when people want physical gold. And they'll want physical gold for a number of different reasons, the most important being that you don't have counterparty risk when you own a tangible asset. And I think people sense that, you know, there's still problems with the banking system. The financial crisis is not over. Economies are still weakening. That means more bank problems developing. And I think the move toward physical metal without counterparty risk is a new trend that is going to continue.
Walk me through the counterintuition of hedging yourself against counterparty risk or a weaker dollar by purchasing a physical asset that's ultimately converted into U.S. dollars.
Yeah, well, what you do is you have to look at gold and what it's doing for you while you're holding it, and basically it's preserving purchasing power. You know, an ounce of gold today buys the same amount of crude oil it did 10 years or 50 years ago. It preserves purchasing power over long periods of time. At times you want to hold it, at times you don't. Right now you want to hold it because not only does it preserve purchasing power, because it is a tangible asset, it doesn't have counterparty risk. Another thing that we're seeing, particularly in my company, a lot of business coming from the UK. As the pound sterling has dropped relative to the euro, people are understanding that there's another risk that they have to hedge against, foreign exchange risk, and gold preserves purchasing power regardless which money you're valuing it in. So the price of gold has risen very high against sterling, not as high against the euro, but it's protected people who have owned gold against this drop in sterling against the euro.
Now, just briefly, traditionally gold has a relationship with inflation, or at least presumably so. That connection's been tenuous at best. Gold has a negative carry, as we've described before. Right. Physical gold costs to hold. In that intuition, then, as interest rates rise, would you expect actually less demand for gold because you get positive carry in an interest rate environment?
Yeah. What you really have to look at is real interest rates, you know, interest rates adjusted for inflation. And right now they're negative, meaning that there is no cost of carry when you're holding gold on a purchasing power basis. And what the Federal Reserve needs to do to save the dollar is what Paul Volcker did back in the early 80s. They have to keep raising interest rates in order to save the dollar. I think Mr. Bernanke believes that he can save the economy and not damage the dollar, but it's a very risky policy that he's pursuing. He could end up damaging the dollar, and if he does that, he could irreparably damage the U.S. economy as well.
That's James Turk, the founder and CEO of Gold Money.